There's a specific version of this conversation I've had more times than I can count. Someone comes in ready to build a custom home, they've picked their lot, they've started design conversations, and they're super excited about this project. And then somewhere in that first, second, or third meeting, the question comes up, okay, how do we pay for this? It becomes clear that they've been assuming the financing looks like a regular mortgage. Maybe they didn't know, maybe they didn't ask, maybe their agent didn't know. And frankly, it doesn't. Building custom, the financing, it's not even close to a regular mortgage. And that gap between what people expect and how construction financing actually works is one of the most common reasons projects get delayed, they get priced wrong, or they fall apart before they start. So I want to walk through how a construction to permanent loan actually works. Because if you're going to build in this market, this is one of the first things you need to understand, especially if your builder is not going to cover the loan for you. Most of us don't, I'll be honest. Some do, and in certain situations, ask the question. Most time, a construction to perm. So let's go over this, and this is what I want to cover. First, I'm going to explain the basic problem construction financing is solving, because once you understand why it's structured this way, it's going to make a lot more sense. Then I'm going to walk you through how a construction to permanent loan actually works phase by phase, from the initial closing through the draws to the conversion. And after that, I'll talk about the parts that trip people up, things that aren't really obvious until you're getting involved in it. And toward the end, I'll get into how to think about this in the context of your overall project and what to ask lenders before you commit to one. So let me start with the most underlying problem, because most people have never had to think about it. When you buy an existing home, the process is pretty straightforward. There's a house, there's a price, the bank lends you money against that value, you close, and you start making monthly payments, principal and interest. Every part of that transaction is stable and it's known. When you build a custom home, none of that's really true. There isn't a house yet, there's a lot and a set of plans, and there's a promise from a builder that this thing will exist 12 to 20 months from now for a certain price. The bank isn't lending against something that exists, they're lending against something that will exist in the future, based on documents and third-party estimates and their own risk assessment. That fundamentally different transaction is why construction loans work differently than regular mortgages. Now, historically, there were two ways to solve this. One was a standalone construction loan where you'd borrow money to build the house, and then once it was finished, you'd then have a second close where you have a separate mortgage that paid off the construction loan and converted to a long-term mortgage. That worked, but it meant two closings, two fees, two different qualification processes sometimes, and the risk that if rates moved or your financial situation changed during construction, you might not have an easy close on the second loan on the same terms that you assumed. That is a lot of exposure on an 18-month timeline. The construction to permanent loan, which is what most people are using now, solves that by combining it into a single transaction. You close one time, at the beginning, on your lot. That closing establishes the terms of both the construction phase and the permanent mortgage that will follow. During construction, the loan behaves like a construction loan. You take your builder, you take draws against it, and you make interest-only payments every month. When the house is complete, then you have to convert it to a permanent mortgage at pre-agreed terms without a second closing. That structure removes a lot of the risk and the friction of building. So here's how the mechanics work. When you close a construction to permanent loan, the bank does not hand you a check for the full amount. What they do is they set up a loan facility for the total project cost. That total includes your land, if you're financing it, plus your construction budget for the house, a contingency reserve, and then soft costs and closing fees and real estate fees. The bank commits to funding this total, but they release the money in stages, which are called draws, which for you is good. These are called construction progress draws. The builder will submit a draw request when a certain phase is complete. The bank will then send an inspector to verify that the work is done, and once it's been verified, the bank releases the funds directly to pay for that phase. This draw schedule is typically tied to construction milestones, foundation completion, framing completion, rough ends, exterior materials, drywall, and so on. The specifics are going to vary by lender, and then when it's pulled will vary by builder. But the logic is always the same. The bank is releasing money as value is added to the property that align with those specific progress points. That way, their exposure at any point in the process is roughly matched to what has been built. And during this construction phase, you're only making interest payments. It's only interest on the amount that's been drawn to that point, which means your monthly payment is going to start small, but it's going to grow as more money is drawn. That is important to plan for, because if you're carrying a mortgage on your current home while you're building and your construction interest payments are ramping up, that is a serious cash flow consideration for the last 6 months of your build. A lot of people don't plan for that carefully enough because the loan and the draws are typically front-loaded heavier because a lot of the basic and bones of the house, which makes up a vast majority of the fees, is in the first half of your project. Then when your house is complete, that loan converts. The construction phase ends, and this is when your permanent mortgage can kick in. Every bank's a little bit different, but at this point, it's when you start making principal and interest payments the same way you would on another mortgage. That conversion is the whole point of this structure. You're avoiding a second closing, you're avoiding another qualification if your bank had required it, you avoid interest rate risk that can come with two separate transactions. Now here's the part that trips people up, because this is where I see a lot of frustration when people are new to this. The first is that you're being qualified for the permanent mortgage at the beginning of the process, before the house exists. The bank's looking at your income, your debt, your credit, and most importantly, your reserves to manage any overages, and they're pre-approving you for a loan that will exist 18 months from now, as well as trying to estimate what your overages are going to be to make sure you have sufficient capital to cover it. So it's not a situation where you can't pay your builder and the loan can't be closed and converted. That's fine if your financial situation is stable or if you're buying well within your means. It is a problem though if you're planning a job change, if you're expecting significant income shifts, or if there's any other financial disruption that you can see on the horizon. The bank will typically re-verify certain things at conversion. So if your situation is materially changed during construction, that sometimes can cause problems that are very expensive to solve on the back end. Every bank is different. Please ask your banker upfront what the requirements are, because everyone does it a little bit differently from their rates, their financing, their draws, their conversion. Is it automatic? Can you hold on your conversion until the end to make interest-only payments, which have some tax benefits? Again, consult a tax accountant on that one, but it's always different. The second thing that trips people up is the appraisal. When you're building custom, the bank has to appraise a house that doesn't exist. So they're gonna do that based on your house plans, your specifications, and an as-completed value. That appraisal is the ceiling on what they're gonna lend against. If the appraisal comes in below your construction budget, you're gonna have to make up that difference in cash, or the deal doesn't work. The appraisal isn't necessarily a formality. It's a real gating item in a market in new construction where values move a lot. It deserves your attention early on. You should be asking your builder, your agent, your developer, hey, are there other closed homes that support this price? If they don't, then you need to ask questions to your lenders like, hey, I'm first into a community. They don't have this. Maybe there's not a neighborhood nearby. Like, is this a risk for me? You also can ask for a second appraisal. People don't know that, but you can if the situation allows, because it can be hard to appraise new construction. The third thing here is contingency. Most construction to permanent loans require some form of contingency, either built into your budget, or they're gonna look at you and what you hold to make sure that you can afford this house. 12 months of principal and interest payments, and then a certain percentage of overage. Sometimes they'll go as much as 5 to 10% of the construction cost, when if you're building a $2-3 million house, that's a substantial amount of cash that the bank's gonna ask you to hold. Again, ask them their requirements. Because that money really, it's there to cover overages, change orders, and unexpected costs, which is good because those things can happen, but you have to understand that the contingency either is or is not part of your total loan. It's not any extra money on top. And so you have to make sure that that is there and that you know that that's coming before closing so that you don't get in a situation where you can't close. Because remember, if it's not in your loan, you're having to borrow more against yourself, against your other assets. But if you don't use it, then that's great. That's money that you didn't spend in your house, and that is awesome. And if you have a great builder, they can help you stay in budget with what they've allocated to you. So how this contingency is treated and drawn matters, and it's worth making sure that you understand it up front. The fourth thing is interest rate structure. During the construction phase, most loans are gonna use a variable rate tied to some index. In some cases, most of the time with a consumer at the end, it's a fixed rate from start to finish. Again, there's a lot of options. Talk to your bank. At conversion, however, that loan is always gonna move to a permanent rate structure that you select at the beginning, whether that's an ARM, a 30-year fixed, that's completely, again, on you and your lender. So some lenders are gonna lock that permanent rate at closing, which is gonna protect you from interest rate movement during construction. Some lenders might lock the rate later in the process, and some might let you even lower the rate if that happens at the end of your build. It also might let you put more principal down right before you convert it so that you can re-amortize early on before you convert. So always different based off banks. And that's a real decision. And it's worth having a clear conversation with your lender about what the options are and what the trade-offs actually look like in this current rate environment. The last thing I want to mention here is the mechanics. These loans require much more documentation, more inspection, more coordination than a regular mortgage. Every draw involves your builder submitting paperwork, the bank sending an inspector, the builder requesting a draw, you signing off on the draw, the funds being verified and then released. That's a lot of steps. If your builder is disorganized by this, or if your lender's slow to process draws, that money can stall while everybody's waiting for money to move. And I hate to say this, but if you don't have a good builder, your subs may not show up till they get paid. I have seen this happen. It's very sad. So the relationship that you have between your builder and your lender matters more than most people realize. Most lenders now require approved builders. That's another thing. Make sure your lender can approve your builder as an approved builder. They do this because the builders who have these systems for it are gonna handle it better. Builders who are new to it, they can create real delays and cause problems for you and your bank if they're not organized. So here's how I think about this if you're a client sitting in front of this decision. Start the lender conversation early. Not after your design is finished, not after They've already given you the contract. Before you go into this, go to a lender and see what you can get approved for on a construction to perm and a regular mortgage. This is important to us at the beginning. Because the lender is going to shape a lot of what's possible for you, knowing your budget with real precision from the start changes the downstream decision. You also want to know this so you can give your builder a realistic budget so that you don't end up building something you cannot afford. I see this far too often. You ask the pre-approval early. A good builder should. If they don't, you could be designing a $3 million house and the builder's just gonna assume that you can handle it when your budget was only ever $2 million. So talk to more than one lender. Don't just rate compare. Understand the mechanics behind each of their loan structures, a one-time close, a two-time close, how their draw process works, and how they handle the parts that come up during construction. And ask your builder who they've had good experience with, because oftentimes, a lender who's smooth to work with on the operational side saves you and your builder real time and stress across the entire project. Most builders have a preferred lender list, and some of those preferred lenders actually can give you better deals. So make sure you always ask this question. Start with your lender, see if they have builders, or start with your builder and then ask the lender. Both ways work. I always recommend both. Ask about the appraisal process specifically. Ask about how they handle contingency, and ask what happens if your construction costs come in over budget, and ask how your rate lock works and when it's locked in. Ask what the conversion process looks like and if there are any fees at conversion. Also ask if it takes longer to build your house, what are the fees associated with that? And then finally, ask about your total closing costs, because these loans have more moving parts than a standard mortgage and the fees can be higher. Most of them are gonna charge you up front for their inspection fees, and that's a surprise, $500, $700, $1,000, $2,000 fee, or more that can be tacked on, and it varies by lender. The bigger principle that's underneath all of this is that construction financing isn't just a simple checkbox because you bought a house before. It's a very important decision in the entire project. It affects your budget, your timeline, your cash flow, and your monthly costs for potentially the next 30 years. If you're someone that lives in a house for 30 years, it doesn't happen, let's be honest. The people who treat it as an afterthought tend to end up more stressed about money during construction, and that carries over into your construction experience. And even worse, it could end up with a financing problem that you could have prevented with better planning at the front. I hate to say it, it could end up to you not closing on your home in time. And that's just a disaster that everybody wants to avoid. So the people who treat it as central to the project, who understand it and who choose their lender carefully, they tend to move through construction with a lot less friction. The fundamentals don't really change with the market or the size of the project. Understanding what you're borrowing and how it works is important. Choose a lender who's experienced in construction, not just mortgages. Plan for the cash flow reality of construction interest payments while you're carrying other housing costs or rental costs. Build honest budgets and honest contingencies, and plan for selling your house if you have to sell your house as well. And treat the lender relationship as a core part of your team, not a transactional vendor. If you do those things, construction financing becomes just a manageable part of your project. Skip it, and it can become one of the things you really wish you'd known more about before you started. Hope this was helpful. If it was, I'd appreciate a like and subscribe. If you're working through the financing side of your own project and you've got a specific question, drop in the comments and I'll do my best to get to it, and also recommend some good ones that I've had experience with here in Raleigh, North Carolina.